Hey everybody, welcome to Keyword Crypto. This is Michael. This week I interviewed Sharon Yip from Crypto Tax Advisors because she's a CPA there, and I wanted to figure out what's going on with taxes because with the bull run of 2020, I know I'm a little nervous, and I know some other people are a little nervous that I've been talking to. So she answered a bunch of questions from listeners and some that I had too. But first, some housekeeping. The new website's up. So go to keywordcrypto.com. I started a blog there as well. I'm reviewing some seed phrase protectors. The first one is live right now, and I'm going to have a video and about 6 more coming up over the next couple weeks. And I tell you what I think about them. I based them off of Jameson Lopp's hardcore punishing test that he did where he took flamethrowers and vats of acid and 20,000 pound presses to him. So I took the ones that stood up to him, that passed his tests, and then I'm reviewing these on just basic usability because he lives out in the middle of nowhere and I live in an apartment complex in Los Angeles, and people don't want to hear me banging away and that stuff. A few patrons that have been pretty supportive for a while. Lucas Morton, thanks, man. Keep it up. Whoever donated on Coinbase Commerce, thank you. And Anchor FM, those are anonymous, so I can just say thank you. And that is rhetorical. Oh, is that rhetorical? You the man. If you don't know, I have this website. I'm probably not even going to do it anymore because I think another website just did it and they had like major VC backing. It was called Edit Crypto, and Is That Rhetorical kind of helped out a lot with asking and answering questions on the website, and he donated a little bit of money, so I appreciate that. All the help helps because it just I want to start paying for it because Zoom subscription and all that, and while I'm not working because of COVID, all those little donations add up and help to pay for those things. So and one thing I'm embarrassed by, I forgot to tell Sharon to turn off her VPN. Totally my fault, so there are some glitches along the way. She cuts out. I apologize for that. I tried to go back and have her repeat what she said. So I promise to do better. I take full responsibility. Totally my fault. I have it on the list. I just completely forgot to tell her to do it. So Sharon, I apologize to Sharon, and it won't happen again. All right, thanks everybody. Here's the show. Now, hey everybody, it's Keyword. I'm just gonna start that over again. Hey, it's Michael from Keyword Crypto. I have a guest on, a crypto tax accountant, Sharon Yip. Yip. I always forget to ask how to say the person's last name. Is it Yip?
That is correct.
Okay. Sometimes it's so obvious, but then we had one guy on and we were kind of butchering his name. And so it's just something I always forget to do, though. Sharon Yip, who's a crypto tax accountant. And I thought this is really important because we had a bull run last year and we're still having a bull run now. How do we navigate all this with taxes? Because if you're an American, especially, you got to pay your taxes because you can get screwed. So Sharon, why don't you give me like a few minute rundown, like how you got involved in crypto and all that fun stuff.
Yeah, sure. So I'm a licensed CPA and I have been doing tax work for a little bit over 20 years, mostly in public accounting, and then later I switched to corporate. Back in 2017, I got in touch with crypto just by accident or whatever reason. I don't remember the details. Someone introduced me to crypto. And out of curiosity, I decided to give it a try. So I bought my first Bitcoin, not the whole Bitcoin, but a small portion. And then I got fascinated by the whole space, the whole blockchain technology. And then you guys probably remember near the end of the year, there was a big bull run and people got excited, and including myself. So I started to invest more and I did a lot of trading. I even got into some cloud mining. I invested in some ICOs and some Bitcoin investment programs, things like that. That's how I personally got involved in crypto, and I spent a lot of time doing research, reading, really trying to understand this whole thing. And the more I read, the more I become excited. Then 2018 came, so it's tax time. As a tax professional myself, I started to realize, oh my goodness, how do I report my crypto transactions? And then I told myself, if I cannot handle it as a CPA, I bet many other people they have no idea, right?
Yeah.
So, and I also realized that I'm not the only CPA who doesn't know how to handle this. Actually, I would say at the time, probably 99 or more percent of the tax professionals they have no clue. So I decided to specialize in this area. So I left my corporate job and I formed my own tax practice. The firm is called Crypto Tax Advisors. And since then, I have been focusing 100% of my time and effort in this space. I serve all my tax crypto clients, several hundred of them in the past 3 years, and from simple to very complicated transactions. I have people, our clients, they have millions of transactions, and some clients they use over 100 different exchange and wallet accounts, things like that. And then I keep a very close eyes on things developing in the crypto space. Is like new things keep popping up. Is very exciting, fascinating to me. I really love seeing so many new things in the space, and especially 2020, DeFi became a very popular thing. A lot of people got into DeFi, and also because of the new bull run after 2 years, 2018 and 19, crypto was down quite a lot. And but 2020 it started to come back up, and we have clients coming to us. Actually, they are new investors. They didn't start until 2020 because there's a whole market and also institutional investors coming into the space. So that's why I still am focusing on the crypto taxation niche. I have a partner who I formed the new firm with. He's more the traditional tax and accounting guy. He's also a CPA, so he's in charge of the more traditional tax. About so we can provide a full range of tax and accounting services. But yeah, so that's pretty much my story.
Do you, when you're talking with your new clients who just got into crypto, do you ever give them advice? Like just
Well,
since you're a crypto person now, like do you ever like when someone's like, "Hey, I'm buying XRP at $3," do you ever be like, maybe you don't want to buy XRP at $3?
I try to refrain myself for doing that because as a licensed CPA, I'm not allowed to do so.
Okay.
I'm not a financial advisor. I need to make it very clear to my clients. But sometimes I cannot resist to express my own opinion a little bit just because I am also a crypto investor. So when I talk about crypto, I got really excited.
Okay.
So and sometimes I just have to really, remind myself I'm not supposed to give any advice. I need to keep that to myself. But
Yeah.
for some clients, the long-time clients, I have several clients. We became like friends, and they are deep into crypto. Some of them they even work in the blockchain technology area. So we talk all the time. We exchange text messages. Say, hey, SRP just got sued by SEC or things like that. So we talk all the time. But as a
Yeah.
tax advisor,
Nice.
I don't give investment advice.
That's probably for the best, but I can see how it might be kind of hard when you know exactly what their investments are.
Mm-hmm.
Um, so why don't we get into the questions? I got a handful of questions from listeners
Mm-hmm.
through the various social media platforms, uh, and then I threw in a couple of my own because I have my own special, as a podcast host who gets some donations. I want to talk about that also.
Okay.
Um, but I think the thing that is scaring a lot of Americans the most is what's up with Binance US switching over to 1099K. Do you know anything about that? Like why they did
Uh,
it?
well, yeah. So, 1099K is not something new. It first started with Coinbase. So a few years ago, uh, the IRS went after Coinbase, subpoena Coinbase, and Coinbase actually went to court. They kind of like partially lost, partially won. They were forced to surrender bunch customer records to the IRS. And since then, they decided to issue 1099K every year to report their users who had during a taxable year, either I believe is the total amount gross sales proceeds from their trades more than $20,000 or the total number of transactions, meaning trades more than 200. But the 1099K actually caused very bad consequence. For example, in the past 2 years, the IRS has been issuing tax notices to crypto investors because of Coinbase 1099K. And later, some other US exchanges, such as Gemini, I believe Kraken too, joined Coinbase in issuing 1099K. So, about 3 months ago, we have quite a lot of people coming to us because they received a tax notice. It's called CP 2000 from the IRS regarding their 2018 tax return. And the IRS assessed a huge amount of tax plus interest and
Oh
penalty.
no.
And their source is based on 1099K issued by crypto exchanges, Coinbase being
Wow.
the main
That's pretty
one.
scary.
Right? We have seen dollar
Um
amounts from like half a million
oh,
dollars
I
to
lost her.
$1.5 million.
1 second.
That's the tax assessment, including penalty and interest.
So hold on,
So,
I lost you
oh,
for 1 second. So I lost you after people started getting notices from the IRS about 2018. So can you
yes,
pick it up from there?
yes. So a lot of people received a IRS notice regarding their 2018 tax return because they did not report their crypto transactions for the year. And the IRS went ahead in the tax notice, it's called CP 2000, assess a tax liability plus interest and penalty based on the 1099K issued by crypto exchanges, the main one being Coinbase. And some people that received their tax notice is actually related to 1099K issued by Gemini. So what the IRS did was to just base on the 1099K amount, which is actually a gross sales proceed accumulative based on the trades that this particular user had been placing during the year and with no basis allowed at all. And then the IRS also treat this as business income because 1099K is actually reporting for money transactions. So the IRS is treating this whole gross sales proceed as business income. So they assess not just ordinary income tax, but also self-employment tax.
Yeah,
And
because
then
I
plus
got a
interest and penalty.
1099K and honestly I couldn't sleep for about 4 nights afterwards because the amount it says gross amount of payment, third party network transactions, and it's like maybe 50 times more than I've ever made in my entire life. And I
Mm-hmm.
looked at that number and I was like, this can't be right. Like
Yep.
I didn't make, I made like 1/1000th of that amount of money.
Mm-hmm.
So from my understanding, and correct me if I'm wrong, is that let's say I have $10,000 and I buy Bitcoin for $10,000,
Mm-hmm.
and then a week later I uh, trade that $10,000 worth of Bitcoin for Ethereum instead. So so that 1099K is counting that as $20,000 of transactions right there,
Well, it's
even
counting
though I may have only
whatever.
made like $100 profit.
Yes, yes. So it really counts whatever the fair market value of your deemed sales proceed. So in your example, for example, if you when you first started, you paid $10,000 to purchase Bitcoin, and then later you decided to exchange it for Ethereum, and at that time your Bitcoin value is 20K already. It's like doubled, right? And then you use that 20K to exchange for Ethereum, thinking that I'm not cashing it out. I just now, instead of holding Bitcoin, I'm now holding Ethereum. And then later you decided to sell some of your Ethereum for another coin. You just keep doing this, right? And you never get any cash
Yeah.
out of the account and keep just like trading, exchanging different coins. So when the year ends, you end up with $1 million on your 1099K. You're like, what? How did I get $1 million? I
Even
never
even though
see
you
that
only
stuff.
have like 30 or 40,000. Okay.
Exactly, exactly. Because it's
Okay.
just like the same money keep recycling and keep adds up. Every single time you do a trade, it adds up. It's just add to the total, and it's
Okay.
all gross amount. Yes.
Okay. So if you're trading with larger sums, that number is going to be astronomical and scary as hell
Oh yeah.
when you get it.
Oh
Okay.
yeah. That's why people receive 1099K showing in $1 million.
Oh my god. Yeah,
Yeah.
when I saw mine I was just like it said like for May it's, like $100,000 worth of transactions. I was like, "What? I had like
Yeah.
in May I had like 5 grand total to my
Mhm.
name." So I don't even understand how.
Right.
I guess I
So
was stupid and was trading too much.
so I do want to use this opportunity to remind everybody it is very important to keep track of your transactions and then also do the calculation, the gain and loss calculation as you go, or at least once the year is over when it's tax time. It's very important that you report your crypto transactions and of course correctly rather than not do anything and wait for the IRS to catch you, because when they catch you they are going to do the calculation to their best advantage, and it will be a big disadvantage to you, because at that time then you will have to go back try to defend yourself, and most likely you will have to hire a tax professional, a CPA, or even some people they go to a tax lawyer. They're even more expensive to try to figure out, and because they get scared, they don't know what to do. So be proactive. Go find a qualified tax accountant to work with you to get everything calculated and then report on your tax return, so you don't have to worry. Because once the IRS sees that you have everything, all the details, everything reported on your tax return, then they know you are reporting. So they most likely will not come after you. Instead, they will go to people who they know are involved in crypto, but on their tax return, there's nothing related to crypto there. Then they know this person, did not report.
Oof, that's that's scary. Um, okay, so next question: how should airdrops that aren't sold be handled?
Right. So this question is very common. The IRS back in 2019, near the end of the year, issued a revenue ruling 2019-24, which specifies that a new cryptocurrency received by airdrop following a hard fork needs to be recognized as ordinary income measured in US dollar based on the fair market value of the coin at the time of receipt by the taxpayer. Now, this revenue ruling does not address airdrops outside the context of a hard fork, such as through those so-called promotional airdrops. But presumably, we believe the IRS will take the same position as for airdrop of hard fork coins. So we believe when you receive an airdrop coin, you need to report it as ordinary income based on its fair market value at the time when it landed in your wallet or exchange account.
When it landed, not when you sold it.
No, not when you sold it. Yes, that's the thing. Because IRS use this logic called accession to wealth, meaning that when a airdrop coin landed in your wallet or exchange account, you already have accession to it, right? Because you can do anything you want with it because it's now in your account. So that means you own this thing. And because you never pay for it and it has value, as long as it has value, then it is something. Then you need to report that as your income because it's like you just received something.
So
Uh,
if you got that Uniswap airdrop and when it landed it was like $6
right.
and then it went down to like $2 and you sold it at $2 because you're like, I don't want to deal with this,
Mhm.
you would owe more than you sold it for. Like it would have been
N-
because
no,
it was okay.
not okay. So it depends. It depends. Here's the thing. So technically, you are supposed to recognize income, all right, at the time of your receipt. So, for example, if it's worth $6 when it landed in your account, you have to report the $6. Now, let's say later the price dropped to $2, and then you decide to sell it. It really depends on the timing. If you sell it in the same year, then you will recognize a short-term loss. So in this example, it's going to be $4. So the net is really just the $2 you have to recognize as income because you didn't pay for it, and then at the end you sell it for $2, so that you did receive that $2, right? If it's the same year, short-term capital gain or loss is the same tax rate as ordinary, so it's like a wash. Even though you have to recognize $6 upfront, but and then you take a $4 capital loss deduction, so it offset it, and then you have this $2 as net difference that you have to pay tax on.
Okay. Okay. So you're
But
okay.
yes, but there's a bad situation, which is actually you have to recognize the income upfront at ordinary tax rate in year one. Now you didn't sell it until year two. Okay, let's say in year two is a big job, is now almost worthless. Now you sell it at a loss because you recognize income upfront. That becomes your basis. Now you sell it at a loss, but because the loss is in year two, you cannot go back and use the loss to offset your income in year one. So that would be a pretty bad situation. Unfortunately, there's really nothing we can do about that.
So if you're going to take a loss on it, do it in the same tax year. Don't wait to the next tax year if you're worried
Yeah,
about it.
I would say so. I would say that's the way, but still, that is not the ideal way because let's say if you have a huge loss during the year with other loss altogether, the tax rule is in every year you can only deduct up to $3,000 of net loss. You can carry over the remaining loss to the future years, but in a single year, you can only deduct up to $3,000 of net loss. So it doesn't mean that you are able to offset 100% of the income that you have to recognize in the beginning
Oh
when you
shit.
received this coin.
That's a disaster because anybody could just airdrop anybody anything without their permission, and
Right.
then the government's like, "Hey, that's your money." And you may not even know about it. Because if you
That's
don't like if
yeah.
you're in MetaMask and you don't add that token, it may be hiding in there and the person would never know. I would never know.
That is very correct. That's very true. So that's why a lot of the organizations, including organizations, professional organizations related to CPAs or even American Bar Association, um, have been writing letters to the IRS to really bring up points like this. It's very unfair. People don't really realize they have received those, especially for those promotional airdrops. We didn't ask for it, right? And they landed in our wallet. And if I don't check my wallet, especially in a lot of the Ethereum based wallets, they really receive a lot of those airdrop coins, and most of them are junk coins. And we
Yeah.
have no idea until we check our wallet. Honestly, I haven't checked my Ledger wallet and Trezor wallet for more than a year now. I have no idea what landed in my wallet. Then how
Yeah.
am I supposed to, know? But I guess the answer will say, well, it is your responsibility. Every year you check your wallet to see whether you received anything or not before you prepare your tax return. But I also want to mention is that most of those promotional airdrop coins, they are really junk coins. That means that there's really no market. Most of them, they are really new projects, right? New
Yeah.
projects they want to promote. They want to attract more people to buy their coins. So they just give out all those bunch airdrop coins. Now, in a situation like this, if the coin has no fair market value, meaning that you cannot really sell it on the exchange, then you can say that this coin has zero value. Then that means that you don't need to report. But the thing is, if indeed later is listed on some exchanges for sale and you are able to actually sell it, then you will have to pick up the whole thing as a gain because you never reported income. That means your basis is zero.
So if you're thinking about doing an airdrop, please don't. If you're a crypto person out there, just don't do it because you're really screwing over the community, especially as an American. What I would suggest is do what Uniswap did: is say these are out there. you have to claim it. So it's putting the onus on the user, and we had to, hook up our MetaMask, click the claim button, and accept it. So there were like 4 steps along the way, and we were the ones fully responsible for that airdrop, for that free Uni.
I agree. I agree.
So I think if you're going to do that in the future, that's the way to go.
I totally agree.
Sweet. Okay, let's get to the next question. Okay, how does this? So let's say, theoretically, I buy 1 Bitcoin. Let's say I bought 1 Bitcoin last year, and I bought 1 Bitcoin this year, and I moved them over to a ledger, and then I took one of the Bitcoins, brought it back a month later, and sold it. How does the IRS know if it's the new coin from last year that's a year old, or if it's the new coin from this year that's less than a year old for tax purposes?
Right. Good question. So as the coin owner, you are responsible for reporting all your trades under an allowable cost basis allocation method, which will decide the order of the coins, which means whether it's the old coin or the new coin that you sold. So currently there are 2 basis allocation methods allowed by the IRS. One is FIFO, meaning first in, first out, which is the default method. And the other one is called specific identification, meaning you get to choose a specific tax lot each time when you sell. If you choose a method, then you have to stick with it for all the years, unless you file a accounting method change with the IRS and get approval if we want to switch to a different method. But coming back to the question, the IRS is not going to ask you, okay, are you using the new coin or the old coin? Instead, you will have to establish a basis allocation method and use it consistently.
So let's say, so the last 2 years, I didn't really know what was going on, so I just used Bitcoin.tax, just because it was the cheapest one, and I'm pretty sure I clicked first in, first out. So if I switched over to like your service, does the IRS know that? Like, does that carry over with me? Do I need to how would that work?
Right. So if you switch to a different software or you start to use a tax professional to help you do the calculation, you are supposed to use the same method that you have been using in the past. But there are 2 ways to change that. The first one is, like I mentioned earlier, you can file an accounting method change to switch to a new method going forward. But that doesn't change anything in the past. Another way, if you don't want to file that accounting method change, because that's going to really kind of like bring a red flag to the IRS, because they need to review your application for the accounting method change, and also it's a pretty expensive process. It's a very complicated form you have to fill out. So what we have been doing for our clients is actually go back and amend their prior year tax returns to use this new method consistently throughout all the years. Most of our clients started their investment in crypto a few years ago. A lot of them, just like myself, started in 2017. So now it's only a few years. So we are able to go back and help them amend their prior tax return. Usually people want to do that is if the new method is giving them a better result, they can actually go back and amend and get a refund. And that happens a lot because by default, FIFO is the method most people use because they don't know anything else. And most crypto tax software, they just use FIFO as the default method. And then when they come to us, we are able to show them there's a different method that the specific identification method that will give them a much better result, because you can pick and choose the tax law that will give you really the best result. And they can actually go back and amend the return and greatly reduce their tax liability. And that results in a tax refund.
What percentage of your clients use FIFO versus the other option? Can you say the other option again? Because you cut out for a
Oh,
second on that one.
specific. It's called specific identification.
Okay. So what
Uh,
percentage of your clients are using FIFO versus specific identification?
we don't really have a statistic because we did not keep track of who is using FIFO versus who is using something else. But what I can tell you is that most people, when they come to us, if they had been reporting their crypto taxes, most of them use FIFO. Just again, because that is the default method, is the method most tax software use. People just like, let it be like that because they have no idea what to do. They're not aware that they have a choice. But after they come to us, it's our standard process. After we finish the reconciliation for our clients, at the end, we review the tax report with them and we show them the comparison of using those two different methods and then let them choose which method they want to use and we provide the guidance along the way.
Okay. And it's relatively easy to pay you to go back and amend the previous tax returns?
Yes, correct. We have done that a lot, especially for people who have never reported their crypto transactions. When they come to us, they have like several years of data. So we have to go back from the beginning because in order to calculate gain and loss for people, even just for the current year, we have to actually look at all the years because otherwise there's no way that the current year calculation will be correct. So
Okay.
that's one thing
And
people.
do you, if you were advising somebody right now and they were just getting involved in it and it's their first time, like, is specific identification geared towards people who are like higher, like people who trade more often, or like, is there a specific group of people that you think benefit from this the most?
Good question. I would say people who benefit the most is actually people who started several years ago, because specific identification will work the best if there's a huge change in pricing over the years. If you only started, the time frame is very short. Okay, it doesn't really make a lot of difference if you use FIFO or specific identification. But still it will because prices like keep changing all the time. So by using specific identification, you get to choose, and you don't need to do it manually. That's the one of the main reasons you need to use a tax software, crypto tax software. So the crypto tax software we use the most is called contracting.info. They have a built-in algorithm to calculate which tax lot will give the user the biggest advantage. And that method is the specific identification because the software will calculate which one and then it will pick that specific tax lot as the basis so that the gain or loss will be most advantageous to the user.
So I mistakenly told people on Twitter that I was interviewing somebody from Coin Tracking, but you say you don't actually technically work for them. You've helped them out in the past.
Right, because we are an independent accounting firm. We are not part of contracting. We work with them. We use their tool to serve our clients, and I personally use them to do my own crypto calculation. But we are not part of their company because they are a German company and we are in the U.S.
Okay. So if if you saw that tweet, then I apologize for making that mistake.
Oh no, no problem. Yeah, people don't know that. That's totally fine. But I'm more like their crypto tax expert in the US. So that's why I'm doing the AMA series with them.
Gotcha. Okay, that makes sense. Next question: if I sell crypto and buy a house,
Hmm.
how am I? How does that? So let's say like I sell. I'm living in a rural area where I can actually buy a house for $100,000. So let's say I sell $100,000 worth of Bitcoin and I buy a house for $100,000. what does that do to my tax? Like how am I taxed on that?
Right. So when you sell crypto, no matter what you do with the sales proceed, no matter what you use it for, you need to recognize a gain or loss on the sale, which is calculated
So
by.
can you say that one more time? You dropped out.
Oh, I'm so sorry.
It's okay.
Yes, I was saying when you sell crypto, it doesn't matter what you use the sales proceed for. You need to recognize a gain or loss on the sale, which is calculated by the sales proceeds minus your cost basis. And you need to report the gain or loss on your tax return. So let me give you an example. For example, if you bought 5 Bitcoins several years ago, when the price was $6,000 a piece, so you paid a total of 30K, and now you are selling all of it for a total of 250K because now the price is 50K a piece, and you use that to buy a house. You first need to recognize a long-term capital gain because you have been holding it for several years now. And the gain will be $220,000 because the sales proceed is 250 and your basis is only 30,000. So you need to recognize this difference as your gain. Assuming you qualify for the 15% long-term capital gain tax rate, you will need to pay actually $33,000 in federal capital gain tax. And in addition, you will also need to pay state income tax on that 220K gain, unless you live in a state that has no personal income tax. Or if you live overseas as a US citizen, you're not required to pay any state tax. And so when you buy a house by using crypto, it doesn't matter whether you first convert the crypto into cash or into USD and use the USD to buy the house, or I have heard stories that actually you can just pay in crypto for buying the house directly. You don't have to
Yeah.
convert it into USD, but it works the exact same way because when you spend crypto, you are treated as if you first sell crypto for fiat and then immediately you use that fiat to do the purchase or spending.
So companies that have access to your crypto, or like let's say, so these companies that are saying like, we're a crypto credit card or something like that. What they're actually doing is selling your crypto on the spot and converting it to fiat and then using that to pay for the purchase. Every single time you do that, you're potentially losing 15 to 30% of your value, right? I mean, you're just paying absolutely astronomical fees just to buy like a quart of milk with Bitcoin versus just using fiat.
Well, it depends. It depends on whether it's a gain or loss. Okay, so let's say if your crypto in your account, you bought it at a lower price. So when you use your crypto debit card to make the purchase, now the price has increased a lot, then yes, you will recognize a gain, and yes, you will need to pay tax on that. But what if when you use the debit card, the Bitcoin price has dropped since you bought it, then actually you end up with a loss. Then in that case, then you don't have to pay tax. Actually, you will be able to use that.
So that milk that was $250 now costs $10,000 because of the loss.
No,
I mean,
that's not how it works. It's not going to be that much, but yeah, but you.
No, I mean like technically, but if you bought like, one XRP for $3.50 and a gallon of milk was $3.50 at the time, and then the XRP went down to 20 cents, and it took you 10,000 XRP to buy that, or not 10,000, like 100 XRP. Mm-hmm. You've lost a ton of money on that 1 gallon of milk.
You are correct. So don't use crypto debit card when you are having a loss.
But even if you're in a gain, aren't you just like adding transactions to your? I mean, most companies charge. Most companies like I'm not sure if you personally, but I know like most of the software companies, they charge like per transaction. So if you're like under 10 transactions, like they'll let you do it for free. If you're up to 500, it's $20, or up to 1,000, it's $100. I mean, like if you're using a credit card on a daily basis, that could be in the process of like 10,000 transactions just from your credit card alone.
Yes, you have a good point. That is possible. If someone uses their credit card almost, I mean, crypto debit card
Not to
almost
try to get you to make
exclusively.
less money on your business. I don't want to try to like take customers away from you, but
Yes, that could be a nightmare. Many people didn't realize that. They thought, oh, it's so cool. I have a crypto debit card. Look, I'm paying by crypto. But they don't realize there's a consequence to it. One is compliance consequence, meaning that you have to do all those calculations. And second is really the tax consequence.
that's crazy. Wow.
Hmm. Yep.
Um, okay, let's move. Okay, so the second part of that is, what if now that Grayscale is not Grayscale, now that there's an ETF, a Bitcoin ETF,
Hmm.
if I took, if I'm moving Bitcoin, so right now, anytime I move Bitcoin, it's counting as a transaction on like a 1099K, right? If I move it from one wallet to another wallet,
Uh,
they're counting that.
I don't think that counts towards the 1099K. I believe uh, they only include it if it's a trade.
Okay.
So moving
Um,
a coin from one place to another is called transfer, and transfers are not a taxable event, and you don't
okay.
have to report it.
Nice. Because in the beginning, I used to use coin tracking like 3 years ago when I first started. And every time I would move it from one wallet to another to like a ledger, it was counting it twice, and it was saying like, so if I had $2,000 back then, I'd move it to the ledger, and now it said I had $4,000. And I was like, I just moved it from one to another, and it's showing up twice now, and I don't understand what's going on. And that's the reason I stopped using coin tracking back then.
Oh, it shouldn't be. It must be either, things have changed so much since a few years ago. All the software companies, I believe, not just contracting, they are constantly improving their features and also trying to keep up with all the new development in the space. Now, another main reason that you are seeing like errors or things like that is because probably you didn't know how to really use the software. So if you just let the transactions import into the software, a lot of the time they are not really correctly imported. And that's not
Gotcha.
really like contracting's fault. It's because the way that transactions got imported there, and that's why you need to be able to know how to reconcile, or you have to hire someone to do it
Okay.
for you.
Okay. So is there any tax implication? Like now there's an ETF, if like say Fidelity, so I have a Roth IRA with Fidelity. So now that there's an ETF, if would there be any tax implication if I moved some Bitcoin from a wallet to the Fidelity ETF? It's like transferred
Uh,
it over or something like that. Like
okay,
could I
so
could I even do that first off?
first of all, you cannot move crypto from a taxable investment account to a Roth IRA or 401k account. Okay, it doesn't matter which is just a coin, or even if you have an investment account which you are holding some Bitcoin ETF. It's just not possible to do a in-kind transfer from a taxable account to a non-taxable retirement account. That's
Okay.
impossible. You can make contribution by selling your crypto, convert that into USD, and then make a retirement plan contribution. That is allowed. But when you sell the crypto, that
That would be
means you
dumb though,
have to
right?
report that,
Yeah.
calculate the gain or loss, and report that on your tax return.
Okay. So don't do that, people. um, okay, what's the next question? Are there any? Okay, another. Um, let's say I. Sorry. Okay, so let's say I bought $100 worth of Ethereum when it was $100. So I have one Ethereum, and now it's $2,000. Um, and then I sold like how do I phrase this question? And let's say I sold $1,000 of it, and then I put it, and then a week later it dipped, and then I bought some more Ethereum with that $1,000.
Hmm.
So all my money at this point is technically in Ethereum. So I'm going to get a bill from the IRS the next year that says you owe money on that $1,000 that you sold because that was realized gain, right?
Well, you are required to report that gain. So if you bought Ethereum at 100, you bought one, and then later you sold, let's say half for $1,000 because now the price is $2,000
Yeah.
a piece, then you have to recognize $950 of gain because your basis is only $50, half of the Ethereum you bought at 100, right? You sold it for 1,000, and that the difference is 950. That is the gain you have to report.
Okay, so they're gonna give me a bill saying, yeah, I got to pay taxes on that $950. If all my money is in Ethereum at this point,
Mhm.
and they say you owe, $300 in taxes, I have to sell some of that Ethereum. Doesn't that trigger another tax transaction? And then I have to pay even more, like pay tax, like kind of double taxes because I'm selling some Ethereum to pay the IRS.
Mhm.
But that triggers another transaction, like that triggers another taxable transaction. So it's like this kind of like never ending cycle of paying taxes on it.
Uh, well, yes or no, because every time when you trade, if you indeed recognize a gain, the tax is never going to be more than the gain that you recognized. Think about that, because the capital tax rate, if it's long term, is 15%, up to 20% at most. If it's a short term, it's going to be your ordinary income tax rate, and its chances are it's not going to be more than 35, 37%. So it's only a percentage of the gain that you recognized. This is one thing. The second thing is that yes, if you keep trading in crypto, you never cash out. There's no cash involved. If you keep doing altcoin trading, coin for coin exchange, it is true that then you probably will end up in a situation that you don't really have cash to pay your taxes. But that's your decision, though. So
Yeah.
that's why we always advise our clients to put aside some cash. So when you sell, don't always just do coin for coin exchange. You do have to sell for some cash unless you have cash somewhere else that you can use to pay your taxes. Otherwise, if you everything you got is in crypto, then you do have to put aside some cash by selling part of your crypto. Don't always just coin for coin exchange. You do have to sell some really for fiat so that you can withdraw the fiat and use it to pay your taxes.
Yeah. So take some realized gains, put it somewhere, pay your taxes with that. Gotcha.
Mm-hmm.
Are you worried with people? Are you worried in general about 2018 happening again, where 2017 had that massive run up and people started selling it and trading for alts right before 2018 hit, and they had to realize all those gains, and then 2018 hit, and there was that massive bear market, and people lost like 80% of their money, but still owed taxes on
Mm-hmm.
all that money they made in 2017?
Right. It is possible. And I hope people learn the lesson, including myself. I was one of those people who didn't realize I needed to put aside some money to pay my taxes. So I learned it, a really hard lesson. So that's why now I have been telling my clients, hey, please make sure you remember to put aside some money. And I always help them review their situation, meaning don't wait until the end of the year. Don't just keep trading and trading and then until the end of the year, oh my goodness, now I have this like $500,000 gain and I never convert any coins for USD. So now I have no money. And then now the market start to drop like a rock. And what do? It's too late. So you
Does
have to do
coin
it
does
actually,
does
on
coin
an ongoing
tracking
basis.
does
Yes.
coin tracking do it in real time, telling you how much your current taxable?
Yes.
Okay.
They do. They have this called unrealized gain and loss report, which will show you for each coin what is your basis and what is the current market value based on, I think they use coin market cap, the index pricing. So they will be able to know the current market value for each coin that you hold. And then you can see the difference, and it will show you either as a green, which means you have unrealized gain, or in red, which means you have an unrealized loss. So if you decide to sell a coin, you will know if you do it now, what you're looking at, whether it's a gain or loss.
And does it keep a running tally of, like, can you convert it to USD so you know, like, hey, at this point you owe, $1,000 worth of money in taxes, so you can have a visual idea of it, so you can like.
You can run a capital gain and loss report and choose to also include the tax calculation, but you have to be able to put in the tax rate yourself because contracting doesn't know your tax rate.
Gotcha.
So, for example, if you put in, let's say you will be in the 15% long-term capital gain tax rate bracket, and then for your ordinary tax rate, let's say is 35%. Then if you put in those two, then contracting will calculate based on the amount of long-term and short-term gain. It will apply that tax rate for you and show you the long-term and short-term capital gain tax, how much you will end up paying.
Gotcha. Okay. So here's one question from a listener is, what's the tax burden if you realize gains into USDC and then gift somebody a percentage of that money?
Okay. So when you realize a gain in USDC, usually it's because you are using crypto to exchange for USDC. If you bought USDC by using USD, there's no tax consequence. So now let's say you do have to recognize a gain for purchasing this USDC, then you need to pay capital gain tax on it if it's a gain. Now, when you then gift someone part of your USDC, there's actually no tax consequence because gifting is not really a taxable event, but that is on the condition that the gift amount is no more than the annual gift tax exclusion amount. So currently it's $15,000 for 2020, and it's the same amount for 2021. And the amount is for each recipient. So you are allowed to give up to $15,000 to an individual, and there's no tax consequence both to yourself and to the recipient. If you exceed that amount, though, you as the donor, meaning the person who is gifting someone else, you will need to file a gift tax return, which is called Form 709. And then you will have to put the amount, to apply it towards your lifetime gift tax amount.
Okay. Another question from a listener is, and he was scared about this answer. He said, what happens if you haven't filed in years, but you've done many, many trades?
Okay. This is actually a pretty common situation, I would say. A lot of people came to us because of this, that they now got scared because they realized that, oh my goodness, I may be in trouble because I never filed. And because they started to hear news that the IRS has been sending out notices to people. So in this situation, I would say definitely you want to act as soon as possible before the IRS catches you. It's much better for you to come clean, be proactive, because not reporting your taxable crypto transactions definitely will bring you great risks, such as IRS audit, or even if the dollar amount is very significant, you could even end up under criminal investigation by the IRS. We would definitely recommend, if you have never filed and you do have a lot of trades, find a qualified tax professional who's knowledgeable and experienced in crypto taxation to help you, because chances are you probably won't be able to do it correctly yourself. And once you get all the transactions for all the years reconciled and calculated, then you will need to go back and amend your prior year tax returns for the years that you have taxable crypto transactions.
Oh my God.
Many people thought if I have a loss, then I don't need to report. That's not true. First of all, whether you have a gain or loss, as long as it's a taxable transaction, you are required to report. Second, if you don't report, how do you prove you have a loss? Third, if you have a loss, why don't you want to report? Because you will be able to actually utilize the loss to take a deduction to against your other income. And if you have more than $3,000 of net loss, you can actually carry forward the remaining loss to future years and use it to offset your future gains. So I don't understand why people thought if they have a loss, they don't need to do anything or they shouldn't do anything. It's actually to their big disadvantage if they don't report a loss.
How many years can you carry over a loss?
Indefinite until
Really?
you die. Until you die, yes.
Because I can't remember if I did. Yeah, I did 2018 and 2019, except I've filed twice. And this will be okay. So I might actually go back and look at that because I'm not sure if I might have skipped a year just because I didn't think about it at that point. Like I said, like I have a loss and I wasn't making any money. I was just like a bartender or something like that. So I didn't really think. I just didn't think about it, even though I did my taxes. So that's good to know. Okay, so you can carry over a loss indefinitely. So if you took a loss in 2018 and you didn't file taxes for 2018, your crypto, you didn't include crypto, you should amend that because then you can potentially carry that loss over in the future and help you out.
That
like
is correct.
right now
If you don't report,
2020
then
and
you are not
2021.
allowed. Yes. Yeah. Sorry. I'm sorry. I didn't know you were still talking. I was
That's okay.
saying if you did not report, you are not allowed to claim the loss, so you cannot carry it forward to offset your gain for the next years.
But you can go back and you can claim it, right? You
You
can
can go
amend your
back and amend it,
taxes.
but here's the catch. Here is the catch. Usually there's a 3-year statute of limitation. So currently, the statute of limitation for 2017 is closing. It ends on April 15 this year because that's the 3 years starting from the filing deadline for that tax year.
Okay.
Now, unless there's some special situation, such as a significant understatement of income, then the statute of limitation will get extended to 6 years. Let's say it's a very normal situation, you didn't report a loss, and that means that you have reported all your income. In the loss situation, that will not create a under reporting of income situation. Then the normal 3 years of statute of limitation will apply. So if after this year, April 15, you want to go back and amend your 2017 return, it's going to be too late. That means if you had a loss for that year, you will not be able to go back and amend and claim a refund for that year. But I believe actually you can still amend and claim the loss for carryover, but that $3,000 net loss for that year, it will be gone.
Okay. And what are the chances of the IRS going back and saying, we think you did something 5 years ago with crypto and actually auditing you for 5 years ago?
Yes, if they have reason to believe that you have a significant understatement of income, the definition being your understatement is more than 25% of your taxable income for the year. Meaning, for example, if you reported $100,000 of taxable income for that year, and your crypto income or gain is 30,000, which you did not report. So this $30,000 is more than 25% of that 100K that you reported. In that situation, the IRS can extend the statute of limitation to 6 years. So 5 years later, they can still come back.
You cut out. You said so. You cut out after 30,000.
Oh, I'm so sorry.
That's good.
I got a little bit. Yeah, apologize for that. Yeah, I was sipping some water because my mouth got dried after talking so much. Yes.
I feel
So
you.
I would say in a example, if you reported $100,000 of taxable income for a year, let's say back in 2017, but you did not report your crypto transactions. Let's say that year you actually had $30,000 of crypto capital gain, which you did not report at all. This $30,000 is more than 25% of your 100,000 income, which you reported for the year. In that situation, the IRS can extend the statute of limitation from 3 years to 6 years. So they can still come back to you in 5 years.
Okay, that's good to know. What can the IRS actually do to you?
Well, if they have reason to believe that you did not report your taxes, did not report your income, they can, if they have information to calculate the tax liability, they can send you a tax notice and with a tax assessment with interest and penalty. And that's what they have been doing by using the CP 2000 for crypto investors. Or they can decide to audit you. So an audit is more serious than just a tax notice because it could be a full-blown audit, meaning that they need you to provide support for every single item you report on the tax return. Or they can, even if it's
And
really
what if
serious.
like
Yes.
go ahead, keep going. If it's really serious,
Oh,
what?
yes, I was going to say if it's really serious, they can even put you under criminal investigation. And we have seen people like that. Some crypto traders, they have actually like millions of trades, and they, of course, they got a huge gain. They became millionaires because of the crypto investment, and they never reported. And somehow the IRS found out, and they send them notices. They ignore the notices. This is a very big mistake. I would recommend everybody, if you receive an IRS notice, please make sure you respond or you hire a CPA or a tax lawyer to represent you if you don't want to deal with the IRS directly. But you need to respond. If you ignore the letter, they're going to keep coming for a few more times. Then they will take very serious action. And I know one of the individuals who came to us for help is already too late. After we, told them yes, we will help, but the turnaround the next day, he told us that he received a letter from the IRS that to notify him that he's under criminal investigation.
Oh man.
So at that time, it's too late. We had to send him to a lawyer.
And you can go to jail for that, right? Isn't that like what Wesley Snipes
Yes,
went to jail
if
for?
it's yeah, it's called tax evasion. If
Okay,
you
so
charge, yeah, if you're guilty of tax
it's
evasion, it is a
yeah.
criminal, yeah, the offense, and you can go to jail.
So that's so we're not, this isn't kids games anymore, guys and
Yeah.
gals. If you're listening and you've made a lot of money from crypto and you didn't report it, you can actually go to jail if you're an American. Um, and so this, take this seriously. I got time for like one or two more if you do.
Sure, go ahead.
Okay. Um, I somebody once said this, and I don't know if this is true. Can you like register as a day trader so your day trades don't get taxed at the regular capital gains, like 35% or whatever it is?
Yeah, sure, but there are certain requirements you need to meet. If you qualify for, it's called trader tax status, and you make the mark-to-market election, then your trading income, which includes gains from trading, will be taxed at the ordinary income tax rate rather than at the capital gains tax rate. Also, you can deduct your trading expenses as business expenses on your tax return Schedule C, rather than if you are just a regular investor, your investment expenses, including trading expenses, usually is not deductible. So, but to be eligible for trader tax status, you need to pass a two-part test. One is your trading activity must be substantial, regular, frequent, and continuous. And two, you must seek to catch swings in daily market movements and profit from these short-term changes rather than profiting from long-term holding of your investment. Also, the trades cannot be in a retirement account. You cannot use automated trading bots or use a investment advisor to do the trading for you. There's no election needed to file for trader tax status. You either qualify for the status or you don't. And also, depending on your situation, you might qualify for part of the year, but not the whole year. If things change, you could lose the status.
Okay.
We recommend that because this is a pretty complicated area. we would recommend that you consult a tax advisor about your particular situation.
Gotcha. How do you like? We're in the wild west right now of crypto. How do you handle farming, especially on something like Binance Smart Chain, which is like rug pull central? So if someone's doing like jumping from DeFi project to DeFi project and farming on all these different projects and constantly realizing gains like every hour, um, just because they don't want to get rug pulled, how do you handle that tax wise?
Right. So definitely you need to be able to track it. You need to be able to measure the gain or income from those activities based on what you received. Farming, like yield farming, it usually gives you some kind of token or reward from the farming. So those
Yeah.
are all subject to ordinary income tax because it's not a like trading. It's not like you have to purchase something and then you exchange it for something else, which gives you a higher value. That would be considered capital gain. And also the same like staking is similar that you put some coins there, you stick, and then you receive additional coins. Then those are not really like trading. They are not considered capital gain. They are considered ordinary income.
Okay. So when you sell it, so does it matter? Just so let's say I'm farming something and I get 100 tokens from whatever project, like ABC project. Um,
Mm-hmm.
how is it considered income? Is it considered income when it comes into my possession, or is it considered income when I sell it?
It's considered if you receive some tokens or coins when it landed in your wallet, that is your income. As
I mean,
long as
because with
you
farming, that's next to impossible to tell because they're just streaming into your wallet, into
right,
your
I was
account.
going to say, as long as it has a fair market value, it's measurable, you are required to recognize the income there. Of course, there's some difficulty in how to correctly record it. Just like you said, it keep comes in like every few seconds or whatever. But unfortunately, the burden is on you. You cannot say, "Oh, it's very difficult because I keep receiving it." How am I going to recognize it? Well, you can hook it up to a crypto tax software, which will do the calculation for you automatically.
Okay.
So you don't really have an excuse saying that, oh, it's too hard for me, so I don't need to recognize it.
Yeah.
Because
Yeah.
under the tax law, you are required to recognize income as you receive it, not wait until a later time that is convenient for you to calculate how much.
Gotcha. Okay. So, what are the chances of? Because I've talked to a few people about this, and I think we're all frustrated as Americans because our laws seem so antiquated compared to the rest of the world when it comes to taxing cryptocurrency. Is there any chance of it becoming kind of like a casino where you don't pay taxes until you walk out the door, until you cash out all your chips? Because right now I feel like like if I registered every single wallet that I have and they could all be tracked, and I put in $100 and I walk out with $150 at the end of the day, I feel like that's a very easy thing for me to handle in paying taxes on those because those are actually realized gains. Until I actually convert something into US fiat, in my mind, it's not a realized gain because I could lose any of that money at any second because even like Tether or USDC could go to zero tomorrow and I'm losing everything. So it just seems like a complete disaster in America with taxation.
I totally see your point, and I personally agree. But of course, we are not lawmakers. We
Yeah.
cannot change the law. So currently, I think the logic behind the tax law is really, again, is the IRS position of accession to wealth. So here's an easy example. Let's say you bought one Bitcoin when the price was $5,000. And then now Bitcoin is worth, I think today it passed 55K, right? So let's say 55K. Then you decided to exchange Bitcoin for Ethereum, and there's no USD involved at all. So your position probably is, well, I didn't gain anything. I just switched from Bitcoin to Ethereum, right? Why should I pay tax on this? And the gain is huge. It's like $50,000 I have to pay tax on. This is ridiculous. I didn't, I don't have any money in my hands. It's just in my account. Instead of holding Bitcoin, I'm now holding Ethereum. But then the other perspective is this: look, if you sell this Ethereum, it's worth 55K because that's how much you paid a Bitcoin to get, right? So the Ethereum you purchase is worth 55K. You could have just sold it for cash, pocket it. You just decided not to, and it's not our problem. If we keep waiting, then we will never be able to collect any tax from anybody because people can just keep trading and trading and never pay tax. Then how are we going to run this country? You see my point here? That's how they think. Accession to wealth, meaning that if you have the ability to change to always cash out right now, then that's your choice whether you do it or not. And that is not a reason for you not to pay tax on the gain.
I mean, I think that's the thing that the people I'm talking with are frustrated with is we're not trying to not pay taxes on the gain. We're not trying to pay taxes until we've actually realized it into US dollars. Like our government's currency that we can actually use to pay taxes and buy milk and do all these things with, can't really use cryptocurrency
I
for the
understand.
most
Yes.
part. So that I think that's our frustration is like, we're not trying to not pay taxes. We're trying to pay taxes when we've actually moved it into fiat, like when we've actually realized it. Because like in my mind, if I bought Bitcoin at 5,000 and now it's 55,000, and then I buy Ethereum with it, I'm not realizing any gain. I don't have any gain in my life, like until it's just on paper. Until I actually, that's what they sell. Like that's what they say. It's not a profit until you actually sell it for US dollars.
I
And
understand your
we're always
point.
saying that
Yes.
to people because it's like, don't count on this money. It's like until you
Well,
actually take profits, you didn't
here's
make any money.
yes, I understand. But here's the difference between a taxable investment account and a retirement account. Your logic works actually, that's exactly how it's allowed under the law for a retirement account. If you put money into a retirement account, you keep trading and you receive income or gain or whatever, you don't have to pay tax until you take money out from the retirement account, right? When you
Yeah.
retire. That's the whole concept about tax deferral. But that only works for retirement account. That's why retirement account is structured in a way you have to qualify. Is limited for the amount of contribution you can make each year. So a lot of restrictions around this because this is a huge benefit, and you are not allowed to take money out until you meet certain requirements, such as you get to the retirement age. Otherwise, if you take an early withdrawal, you have to pay 10% penalty plus income tax for the amount, right? So, but a regular investment account is totally different. You have complete freedom to take money out with no penalty at all, anytime you want. So that's why it's taxed every year on an ongoing basis, not deferred to a point when you actually take money out. So that's the main difference. So that's why actually myself, I'm doing it, and also I have a lot of clients doing it, is really to invest in crypto by using a self-directed IRA account, which is the qualified retirement account. Then you can do so. You don't have to pay tax until you actually take money out from the account.
Wait, so say that again. You can do a self-directed IRA.
And invest in crypto.
Okay.
And as long as you don't cash out, you don't take money out from this retirement account, there's no tax due.
And are you able to amend your taxes and count that money as a self-directed IRA?
No, you cannot go back. It's not retroactive. you is going forward. So if you put money into a IRA account and then you use that account to invest in crypto, then going forward, all the income or the gain earned in that account, you don't need to pay tax on it because it's a retirement account.
So, but what is it? Is it like a specific MetaMask wallet, and you say this is my self-directed IRA? Like,
No, no,
how
you
do
have to
you?
set it up. Yes, so that's why I was saying there are some very strict requirements to set it up. You need to have a qualified custodian, a third party company to act as the custodian because they need to file a tax form for you for, or I would say for the retirement account to the IRS every year. And all the assets must be under the IRS, I'm sorry, the IRA like name. You have to set up either a trust or a so-called checkbook IRA, LLC, so that you can put everything under that LLC or trust as the IRA account assets. You cannot commingle it with your personal assets, otherwise it's going to disqualify you from the retirement account treatment, and you have to pay tax on everything.
And does that
So
third-party custodian have control of your keys?
no, if it's a self-directed IRA, then it's no, it's not. If it's a regular, then yes.
Okay.
So there are two types of popular crypto IRA accounts set up. Okay, one is you use a third party. It's like a brokerage firm that they invest everything for you. You get to choose what you invest, but everything is under their control. If you need to make a distribution, you need to go to them and ask them to send the money to you. Versus another type is called self-directed IRA. You have the complete control of what assets you want to invest in. You even can control the bank account so that you can send money between, convert money like from cash to crypto, and you can set up a exchange account under the IRA name, and then use that account to trade. And after you trade, you can actually send some into a hardware wallet. Make sure that the hardware wallet is solely for the use by this retirement account, not with any of your crypto asset. Then you can designate this hardware wallet as a property for this IRA, and you can send coins there and hold it, store the coin in that wallet. So everything has to be very specific, very clear. This is the property of this self-directed IRA account. Then you can do it that way.
And how difficult is it to um, create that entity?
It's not. There are some service providers out there that they actually do this. This is what they do. They just help you set up either a trust or a LLC, and you can use it to do the self-directed IRA. And there is a trust company that they usually refer you to that will act as the custodian. They have all the legal work, everything, paperwork, everything all already set up. So it's a pretty robust process, and it's pretty easy. It takes about like maybe 3 to 4 weeks for the whole process from setup to get your money into the account. And then also you have to spend time to set up the exchange accounts. It takes more time to apply for a entity account versus a personal exchange account. You need to make sure you provide them all the paperwork, and you need to, yeah, of course, there's a fee involved. The one that I used, it costs a little bit over $1,000 to set up the entity with all the paperwork that they will give to you. And then also you
Okay.
have to contact the custodian, and there's a fee, annual fee. It's not very expensive though, that you have to pay to the custodian every year so that they maintain
Oh,
all the
she's
records for you.
offline. Let's see if she comes back. You went offline for a second. So you said you spent $1,000 to do it.
Yeah, I spent a little bit over $1,000 to set up an investment trust, and I use that trust to do my self-directed IRA.
Is that trust an LLC?
No,
Okay.
there are two types. Like I said, you can either do a trust or a LLC. So LLC has been very popular until recently, but the downside of owning an LLC, the LLC is same as a regular LLC. So you need to pick a state to form the LLC, and then you need to pay LLC annual registration fee, okay, to the state,
Yeah.
which is additional cost to maintaining this,
In
like paying
California,
the
it's
custody.
$900.
Oh yes,
It's crazy.
California is the worst. I was going to say they have this $800 LLC annual fee, plus the whatever registration fee. So
Yeah.
that's why LLC is more expensive than rather a trust. Okay, a trust is not a state entity type. It's actually at the federal level. It's an investment trust that you can form, and the third party company will do the whole paperwork and set up the trust for you, including getting the tax ID and everything. That's why they charge you
And
a
so
thousand
would
dollars.
you advise people to have 100% of their crypto in a trust like that?
Probably not. I would definitely recommend diversify. Putting everything in crypto is very risky, as you already know. Crypto is a highly volatile asset, very
Oh no, sorry.
risky.
I just meant like 100% of their crypto holdings in that.
Well, I don't think you can because, like I said, there's a lot of limitations for retirement contribution. You need to meet the requirement, and every year you can only contribute up to a certain amount.
Oh,
So
gotcha. Okay.
let's say if now you have $100,000 worth of crypto, right, in your portfolio, you cannot just like sell them all and then move this 100K to a retirement account because you cannot contribute 100K a year to a retirement account.
Yeah. That's smart. Yeah, that makes sense.
Yeah, you need to do it gradually.
Okay, well, I really appreciate you. I kind of got to wrap it up there, but I really appreciate you coming on and answering these questions.
No
Because I
problem.
know I was like 90% afraid, 10% not afraid, and now I'm like 85% afraid, and so it definitely dropped my fear level a little bit,
Mhm.
just because of this last bull run. Uh, so how can people get a hold of you, or get in contact with you if they have more questions, or if they want your service, if they want to hire you for their taxes?
Yeah, sure. So my original firm is called Crypto Tax Advisors. Um, they can visit my website. There's a page or an icon that they can click to actually schedule a free initial consultation call with me. And my website address is called crypto and then dash taxadvisors.com. It's pretty easy to remember. Or if you Google just crypto tax advisors, usually my website will pop up on the first page of Google.
Okay.
And you go to the website and on the homepage, I think it's on the top right hand side, there's a big icon saying that schedule a free consultation call. Then just click that, and then you can schedule a call with me, and then you
Nice.
can reach
And
me.
I'll have all
Yeah.
this in the show notes, how to get in touch with her. Um,
Okay.
so thank you so much I really
No
appreciate it.
problem. It's a pleasure. Yeah, I do enjoy talking about crypto and crypto taxes. So it's fun. Thank you for inviting me. Thank you so much.
Great.